In episode 79, we extend the debate, the hot topic around properties versus stocks. And we use the opportunity to really dive further into some of the points that we discussed in part 1. And we use part 2 to kind of go into sort of advanced strategies, what you can look forward to if you decided to be pro-property or pro-stocks. Once again, we stick with the teams, we continue the debate. And on this episode, we actually have a bit more respect for each other and give each other a bit more space to learn and listen. So stay tuned. We hope you have enjoyed it.
And one last quick message before we hit the music. In case you've missed it, we started Take Flight Takeaways episodes. So these are short, bite-sized episodes between 5 to 10 minutes that we release every second week. And if you've missed it, then please make sure to check out the episodes that we have. Kabilo started us off on episode 74, where he talked about saving for a rainy day. I had the lead on episode 76, where I spoke about a great book written by an author called Naval. And Olu did a fantastic episode number 78, which was out last Friday, about how he's navigated his career path. So in case you've missed it, please do make sure you check them out. They're very short, quick episodes, and we hope you like them. And another bonus little message, we have merchandise restocked. We have hats ready. So more information will come, and these hats are the best hats that we've done so far. So looking forward to getting this out to our amazing audience. And I think with that, we can start with the music.
Take off, take flight with you. We never fly, but
guys, welcome back to episode 79, part 2 of the stocks versus property discussion. So before I get into framing what we're going to talk about today, we'll just do a quick round of how everyone's doing. Olu, we'll start with you. Maybe you can talk a little bit about your golf technique and skills.
Left it.
Or lack of it.
What you can say, Shaw?
No, go ahead.
No, I've been schooling these guys at golf for years now. It's starting to get embarrassing. You're trying to take guys that used to be in the hood, try to give them a little bit of culture. And some of these people are playing golf like they're Charles Barkley. If you haven't seen that video, Google Charles Barkley's swing or stroke. Some of these guys have got some poor strokes, but no, it's been good. Bank holiday weekend, obviously.
I'm going to say you've probably seen a few strokes in your lifetime, Olu.
Not as much as you.
Anyways, Olu, how's the new role?
Bank holiday was good. Was able to relax, refresh. New role is fantastic. Hectic at the moment. We've got a few like 6-year reviews or 6-year strategy reviews, which is the perfect time to come in because you're learning about so many different businesses and products. But it's a lot of information. It's like information overload. But I'm enjoying it. It's interesting. Can't have any midday naps anymore. So, you know.
Were you doing that? How often were you doing that before?
Fully focused and locked in. So it's good. The passion is
your
back.
ex-employer hears that. Daniel, how's it going?
Yeah, I'm all good. Not too bad. Nice long bank holiday weekend. Got myself a little toy, an electric scooter. Just been playing around with that. So yeah, bit of an impulse buy. I'm not gonna lie, but it's a good fun toy so far.
What made you get it in the end?
It's not even, it doesn't even make sense. I saw someone on Sunday. I saw someone on Sunday. I had one. I had a little go on it. Went round, got back in the car. I told Melissa, "Oh yeah, I might buy one." She goes, "You're joking, right?" I said, "No, I'm being serious." That night we got home, searching. On Monday, call them up. You open today? Go down to London Bridge. Bought it.
You went?
Come back home. Yeah. Went to the shop. So within 24 hours, I'd gone to buy it.
But sometimes they say that's the best way to buy, like quickly. Don't take too long to think about it.
It was an impulse buy. I don't need it. It's a toy. The reason what funded it is one of my investments. Actually funded the
okay.
We can get into that. Wait, before you go any further.
Daniel, was it one of those liquid investments? You didn't have to like
very liquid. Yeah.
6 months getting the money out. Quickly.
I hope you included that selling of assets in your tax return as well, Daniel. I'll pay tax on that one. So
no, the amount I sold is within my allowance, so it's all good.
Okay. In case the tax people are listening, I'll double check that.
Sure, how you doing?
No, all good, man. Final last few days of last week or so of Ramadan. Looking forward to getting back into a normal routine, flying back to see the family and friends for Eid. So yeah, looking forward to it.
Yeah, same on my side. Family's good. I'm well. So that's the main thing. And the last 10 days of Ramadan now. So I've decided to come off Instagram. So I'm literally just using the last 10 to just lock in and make the most of it. Yeah. So
that means for you, you're probably going to free up a lot of hours in the day based on that episode that we did.
Probably. Yeah, probably. Guys, this is part 2, episode 79. And before we get started, if you are coming into this the first time, we strongly recommend you to listen to part 1. Part 1, we had the opportunity to split up in teams and really touch on, if you were to go with stocks, if you were to go with property, why? And everyone here made strong cases onto each asset class. So we discussed things like which one has more control, which one has probably a stronger return on investment, which one is easier from a transactional cost to get into, where the tax advantages, where can you leverage. So I think everything that you can think of when it comes to stocks and property was discussed in part 1. So definitely please check it out before listening to part 2. And the idea for part two is to first complement a little bit on part 1. So we're going to reflect a little bit more on some of the points that we mentioned, because now we've had some time between the 2 episodes to think it through. And then we want to spend perhaps the second half of part 2 talking a little bit more about advanced strategies. So if you decide to go with stocks or if you decide to go with properties, what can you look forward to as an investor the longer you're in the game? And maybe some of those advanced strategies can actually tackle some of the points that the other side has made. So that's part 2. That's the plan. That's the agenda. Now, what I want you to do also is lick your lips and stay tuned for part 3. Right, it's the final part of this discussion on stocks and property, and in part 3, we're gonna dive into personal case studies. So the guys here are going to share numbers to strengthen their case, their personal experiences, and then they can be very subjective as to why they actually go with property and stocks. So we've got a good plan for you guys. Stay tuned, and we look forward to getting started on part 2. So good with that, guys.
Yeah, sounds good. Gloves are off. Olu, just double checking you don't have any secret outfit changes or anything planned for this episode. It's just going to be a.
Do you want to start with a disclaimer, P?
Yeah, sure. So I think it's important to mention that everything that we're discussing in part 1, part 2, and part 3 is not financial advice. It's merely a discussion for you to reflect on some points to think about. If you are looking for financial advice, then we would recommend you to speak to someone who's qualified in that space to really get that understanding before making a decision. This is just.
Yeah, just listen to Olu and myself. We're qualified, so because obviously the stocks is the right way. The
that
property
makes it even,
is probably fallacy.
That makes it even worse.
I'm playing it's not financial advice.
That makes you
speak to a professional.
Perfect. Cool. So since the stock guys started, look at Olu's face. Since the stock guys started on part 1, we decided that we're going to go with the property guys to kick off part 2. So yeah, just a couple of things. So I was listening back to episode 1, and I wanted to start off by saying, right, so there's two or three points that I wanted to mention, and then Shaw can mention. I wanted to start off by saying, because Olu so passionately said it the same way, men lie, women lie, Olu lies, numbers don't, right? And what I wanted to
wait, let's move that back. Milo, in case people didn't hear you, do you mind repeating that? Say it a bit louder for the people.
So one more time, in case you didn't hear. So it's men lie, right? Women lie, Olu lies, right? Numbers don't. And it's to dig a little bit deeper on the return on investment discussion and the point that you raised. And all I want to basically do, bring it back onto the table to kind of make sure that we're comparing apples with apples. And what I mean by that is, you made a I think I'll say a factual point around the fact that if you look at from an asset class standpoint, right, historically over the last however many years, stocks have S&P 500 have returned sort of 10%, 10.5% compared to property, which is sort of 4 to 5%. But I think leaving that as a loan doesn't provide I think the best context for a listener. And so, and what I mean by that is, when we're in property, what we talk about is return on investment is return based on your capital employed. So if we compare the return on investments based on how much you've invested, I think that's also an important discussion to have, right? So I would actually make the argument that if we look at it from a stock standpoint, right, some of the best, strongest companies, dividend yields are 1.8% to maybe even 3% at a push. If you look at property, on the other hand, I would actually argue that there's actually probably higher returns from a capital employed standpoint. So I wanted to do is make sure that we didn't just leave the return on investment based on asset class, and we actually spoke on thinking about it in terms of, if you invest your money, how much you're going to expect back. So I think that's an important point. I'll leave it there. And we can obviously, when we get into the discussion point, we can go back. Sure, you want to mention your point?
Yeah, so just to build a little bit on Pierre, actually, maybe the point that Daniel mentioned earlier about how he funded his scooter through his cryptocurrency selling. I think the point that I also wanted to re-emphasize is this tax efficiency that I believe in terms of property investment versus stocks and share where you can invest. And essentially, in property, what Pavita and I were really focused on and mentioning was about the cash flow. And I think, Olu, you mentioned about the dividends which you can get as well. But I think if we focus on the cash flow and then operating property investment as a business, I think there's a strong play to say that it's a lot more tax efficient of a vehicle, plus you get the cash flow on top. And the reason why I say that, I think with a stock, even if it doesn't pay a dividend, if it's increasing on paper 10x, 100x, 5x, 5%, then that's just basically paper wealth that's being created, and you don't realize that until you sell it. And upon that point of sale, then you have to pay tax rate on that. Now with property, you can basically, with the property investment, set it up in a way where you can run it like a business. So you have operating expenses, so you can become a tax efficient operation. And as well as that, you get the additional cash flow every month as well, once you've got a property portfolio, which is at a relatively good scale as well. So that's just the other point that I wanted to highlight. If it wasn't clear in the last one, because I think there was a bit back and forth, I still believe that there is a more tax efficient way of doing this investment in property versus stocks and shares, where you only get that gain or benefit once you sell, and you have to pay tax on that. And then Pierre, I think I'll pass over to you for the last one.
Yeah, and then the last one, again, I wanted to provide a bit more context to that point and give it its proper wrapping. It's speaking back to the point on low transactional fees. Now that's not something that I'm arguing, but what I will say, I think the way in which it's been set up and compared, yes, it may be next to nothing to get into the stock market, and you would need more funds to get into property. But I think in the end, people invest for return on their money. So if you actually look at how much, and I think I mentioned this on part one, but maybe it wasn't clear enough. If you have to look at how much you actually need in the property market to earn the same amount of money you probably need in property, you're looking at a lot of capital. So I think that's important for someone. I think that's important for someone to understand as they're going into it, right? It may be next to nothing from a fee standpoint, but if I want to earn £300 a month or 3,600, how much do I need to put in for, let's say, Apple stock or some of the best companies in order to earn the same amount, right? And if we look at the dividend yields at maybe 2%, 3%, you're probably looking at 100,000 plus in cash, right? Over time or in terms of as a value. So I think it's important to understand that from that perspective and that lens. So yeah, those are the couple points that we just wanted to sort of put back on the table to provide some context and have a discussion on.
Well, thank you for saying it. It sounds like you're trying to qualify what you said, because you're trying to add a bit more meat to your previous points rather than rebuttal to what Olu and I said. And Pete, going back to what you said about the last low transactional fees, if I recall correctly, in part one, you on many occasions re-emphasize it's about someone who's in a 9-to-5. So when it comes to startup capital for stocks or property, it's a no-brainer that someone in a 9-to-5 would have the proclivity to go and lean towards investing in stocks.
Jeez.
That's the only point I wanted to say, to be honest. Olu, anything you'd like to add?
But
can you guys hear me, or am I frozen?
No, we can hear you.
We can hear you.
But Daniel, I want to just be super clear. I'm not contesting that point, But what I am saying is that person's expectation needs to understand, in order to earn, right, something somewhere near property, you would have to have quite a lot invested into the market. That's the point I
The
wanted to bring.
difference, I think the point on that one, the
And
point
that
on
speaks
that,
to
I think,
leverage.
no, but I think talking about that, P, is for you to get started, right, you need a large sum of money with property. Whilst you're building up that large sum in stocks, your money can work for you. So what I mean about that is, let's say, for example, 20K. You can't purchase a property with your first 100 or your first 1,000 whilst you're saving to that 20K. From day one, when you decide, you know what, I want to get on this stock as a generation of wealth, you can start investing from that first £100. So when you get to that 20K that you've invested, where it's now comparable to property, your money's already working for you, versus if you were saving a large deposit where your money's not working. Typically, like we always talk about, right, as you're holding that cash, if you're saving for a year, 2 years, your money's actually even worth less because you're saving to be able to get into that property game. So that's one way to consider it. I think, P, another point that you mentioned was, I think the first point, men lie, women lie. You said Olu lies, but numbers don't. I feel like you said last episode, you were being sly, sneaky with your response. What you're talking
Being
about is
slick.
That
I
was
said
the
the
word
word
you used.
slick.
Slick, slick with your return.
I mean, that thing is, the fact that Olu's brought that up, that got to Olu last episode. He had that back and he was like, ooh.
No. I got my points. Which I'm going to mention when I was listening back. But I don't feel like you've actually argued a case. Are you trying to say that property has a better return than stocks based on historical data, or are you just saying that you can get greater yields with your capital? I wasn't really clear about your point.
Correct. No, I think what I want to do is just give it its proper context. So you can make the case that stocks has historically performed better than property, but you can't just leave it like that, right? And I think when we look at return, because in the property world, we don't talk about our asset increased 5% every year. We talk about how much you get in based on your capital employed. So I think what's quite interesting is when we talk property, we talk about how much did you invest, how much are you getting back. But in the stock world, you say every year it's going up 10%. It's two different return on investments that we're talking about. So I just want to basically bring that kind of apples to apples comparison.
But I think when you do an apples to apples comparison, then you're not looking at your principal balance, in which I was referring to last week. You're more looking about basically comparing it to like a dividend stock. So if I look at dividend stock, right, most dividend stocks, you're looking at a range between 3 to 6% return on your yield based on your investment, right? What do you typically see in property in terms of yield? Because you sent me a really nice chart where I saw certain properties in London not getting 3%, right? If I compare that to the stock market,
London's not the only place you can. Okay, London's not the only place you can buy property, but it's not only dividend stocks. I think you refer to dividend stocks, but let's take a stock that doesn't pay each month, right? Because a lot of people invest into those, right? And then what does that look like on a monthly basis? And I think also it's important to shine the light on companies that are well known, right? Big brands, and looking at how much they actually pay out each month and what's their dividend yield. I think that's quite important as well.
Yeah, because that's I had that as a point when we go to your section and some of the stuff. But I think you're making a statement that is not based on any. You haven't shared any sort of financial or numbers to back it up, right? You can look at multiple sources, even quickly Google. I can share it on the Instagram page where it clearly shows that the returns on stocks surpasses the returns on
that's my point.
Property.
What returns now are you referring to?
Whichever way you count it, if it's appreciation or if you're looking at returns,
so you're saying
the value. Yeah.
So dividend yields are stronger in stocks than it is in property. That's what you're saying.
It's subjective, right? That's why.
No, it's impossible to say that because you haven't got the leverage on stocks.
Yeah.
So let's say, for example, I take a property now. I take a personal.
Stocks.
So if I invest £30,000 now in, right, because of the asset that I'm getting myself into, let's say it's £100,000, I can expect realistically, let's say projected to do 10%, I can expect 8% in the first year. return on my capital employed, not speaking to the asset class. But that's the truth, Olu. And we can look at that in part 3. But we can part that one to part 3. But
We'll
I
look
think
at that in part 3.
the point I want to make, because you spoke about numbers, and those are real numbers. The point I want to make is the fact that someone listening needs to understand that return on investment can be looked at in 2 ways: your capital appreciation, right, or the asset class, which I think you're referring to, plus the dividend yield return on investment, which some people are more focused on than the first one.
Yeah, I think if you're looking at it from a cash flow stance, I think you want to focus on the yield from a dividends, which, like I mentioned, you can see between 3 to 6% based on certain stocks. If you're wanting to look just more as an asset class, I don't think there's anyone that can challenge on that. Stocks has historically had a greater return. And then just the last point on the taxes that Shawal mentioned. I think last week we discussed that when investing in the stock market, there's many different techniques and strategies similar to properties where you can reduce your tax exposure. So if that's investing in an ISA, which means for any dividends that you get, you pay 0 tax on that. Or if it's go on.
I was going to say, well, so what's the cap in terms of ISA investment?
You've got 20K is the maximum you can put in there in an annual basis, but that can increase to whatever amount. And if I'm talking to most people, right, you're looking to invest over a period of time. So 20K, putting that in an annual basis. And then outside of that, there's other tax advantages for getting your dividends. So I think you mentioned in regards to appreciation and selling your stocks, I see that the same as if you're selling a property, you're going to have to pay tax on the capital gain.
Okay, can I just, before we give the floor to the stock guys, can I just say to the listeners, have you noticed that we're trying our hardest not to interject and cut each other off? We're really trying to pace ourselves and speak with a level of respect, right? So I hope you appreciate the patience that we have, because I can tell you now, like, we both want to go off, right? So I'll pass it on. I'll pass it on to the stock guys.
In regards to, I listened to the previous episode, and I think there were some great points that came up. Yeah, great points from both sides. I think there was a.
I can't see all his face. I can't see all his face. It doesn't do justice. I need to see his face. Go ahead.
Let me see if I can reset this. Let me see if I can restart this.
You need to. You need to. I think it's just
your
face.
Yeah, that's the entertainment value.
Just give me a second, guys.
And also, you can tell Olu's about to make a deep point because he makes a face before he starts talking, and then it's like, okay, Olu's come locked and loaded with something to say.
Perfect. Olu's here. Yes.
Working now?
Yeah, I got you. Got you. Your face is here. Let's go.
Can you change the order to how it was before in case the video clips look strange? If you can't, then just leave it.
It's gonna be long. I have to remove you guys and then add you back in.
No. It's fine.
Okay. So I want to start off by saying, look, I listened to the previous episode, and I want to start by, there was a lot of great points. But what also was apparent was the lack of understanding on you guys' part to the stock market. And I think that's based on the fact that you've been heavily going down the property lane, right? You guys are experts in the property side. You had great points in terms of arguing why property was the right strategy for you guys. And I think all your points were perfect. But I think listening to some of your arguments against stocks when we're talking about like tax, dividends, it clearly showed that you had surface level knowledge on the stock element. So one of the key pillars.
I just want to remind you, we're not disrespecting in this episode. We want to
sorry, there's no disrespect. But I'm saying, like I said, it's based on the fact that you guys are experts. It's because you guys are
patronizing. We're not patronizing. We want to.
This sounds like a manager talking to an employee.
I started with a compliment.
You've done really good.
They say you should.
This is even worse. This is even worse than part one. This is worse than part one.
Okay, let me scrap that. Let me start again. No,
I
don't want it to come across as.
Continue. No, continue. It's good. Continue. Just don't drag it out.
Okay. So the first point I think that was mentioned is P. You said a lot of top companies don't pay dividend stock, and if I ask you guys, what is the number one company right now based on market value, it's Apple, right? Number one company in the world, tech company, growth company, they pay dividends. Now, you're looking at dividends, and I guess it's the same with when you guys look at the property, is you shouldn't only think about the dividends today. You should think about, okay, what's Apple going to look like in 5-10 years time? Because a lot of these companies will be increasing their dividends amount year over year as they become more profitable, more cash flow. That's going to, Microsoft also, another top company that we know, pays dividends. So there's a lot of movement to see in that a lot of stable companies that are generating a lot of cash, the best companies, are actually paying dividends. The next thing which you mentioned, which I agree with, but I think you guys overemphasized it, was the control that you have with managing a property. And yes, you do have control, but your control is dictated on the market. And what I mean about that is the market decides what the value of your property is. You can do refurbishments and everything like that, but if you put your property on the market for £1 million and no one wants to pay, you can control how much you put it for, but the market controls what the price is. Same with your rent. You can decide, hey, I want to charge 2K for rent in Liverpool. No, because of the market has already decided what the rental price is. And that's why so many landlords have complained about they're not seeing such a large amount of appreciation when it comes on the rent that they charge their tenants, because that is dictated by the market. And then my last point, which I wanted to address, which I think we kept going back and forth in the other episode, that I wanted to clarify, that was around the passive income. Yes, property is a passive form of income. When you compare it to your 9-to-5, yes, it is more passive than your 9-to-5. But when you compare it to stocks and dividends, it is not as passive as stocks and dividends. And then just a correction of myself for the people that listened to the previous episode. I just wanted to clarify, when I mentioned that stocks guarantee an annualized return, I just wanted to make sure that I clarify what that means. So what does annualized return mean? Annualized return is you look at the returns over a particular 10 years, and it tells you what is the average annual return that stock or that property has returned. So that's not me saying, oh, this year is definitely going to be 10%. What that means is it might go up one year 20%, the next year down 10%. When you look at the average of the 2 years, your annualized return is 10% year over year, roughly. So that's how you should think about that. So I just wanted to clarify that in case that didn't come across clearly in the previous episode.
Great. Daniel, do you want to go, and then we can move into the discussion?
I just stand by what I said. I don't think anything I said was fallacy. I think it was all facts. I think it's all accurate. I think it should all be construed as how I said it. I do think that you're trying to be slick by throwing some low blows below the belt to try and catch me up. But I think that also comes down to, your knowledge of the stock market, as Olu mentioned. No, I agree with what I said. I also hear what you said, and I think the points you've raised are very valid. But when it comes to looking even in the short term and the long term, there may be slight advantages on stock. However, depending on your risk appetite, depending on what drives you, and we can come into kind of a winner or what we would vote maybe at the end of part 3. I don't want to let my
true position.
I don't want to let my response out of the bag now. But there are arguments on both sides which can be favorable. There's no doubt about it. But we can get onto that in part 3. That's all I have to say.
Good. No, so before we get into, let's have a quick discussion. Sure, let's have a couple, I guess, response to Olu's points. And then what we're going to do, just to remind the listeners, so we focused on part 2 and get into sort of deeper and more advanced strategy. So we're going to just conclude this discussion here, wrap up the full discussion of part 1, and then get into some advanced strategy. So if I just quickly, just a couple points to Olu's point. In terms of the control element, I think the point was around, so I can kind of see what you're trying to say, but not really. But in terms of the control element, it's more control in a sense, it's more control than the stock in which you hold. So no one is going to set a rent of 2,000 in a market that they went in knowing that the prices are 600. What I mean is, I think you can influence the rent and the price to a level of to a certain point based on the way in which you keep the property and the way in which you upkeep it, right? So you can't influence a stock in a similar way, right? So I think that's the element of control. Both asset classes you don't have full control on, but I think there's a sort of edge from a property standpoint just based on that point. With stock,
I agree with you totally there, P. My point was just more to balance it a little bit more, because it sounded like you had full control in the first episode, and I wanted to just bring you back in and just say, hey.
A bit more context. Hey. Okay, I'm with you.
Context, yeah.
I'm with you.
Of that control.
On the passive income, I can't disagree. I think the only thing the thing that keeps coming to mind when you say that is, people need to keep in mind how much they need to have invested in the stock market to earn what you want to earn from property, because of the leverage. So I think that's the only thing I will say to the passive income. But 100%, dividends are a lot more passive than property. But how much you need to put into each vehicle is going to differ significantly. So that's the perspective to keep in mind. Sure, if there's something you want to add, and we can move on to.
Just to tag in very quickly on that point, I just wanted to check, because Ollie, you mentioned Apple. What's the dividend yield of Apple?
So at the moment is 0.7 percent.
Just say it one more time.
0.7.
0.7%.
So
then
if you had to,
So based off of
if you had to make £300 a month,
how much Apple stock would you need?
But over, just to say, I just want to make a comment. So over the last 5 years, the average is 1.37.
Yeah. So 1.37. But even with that, I know what they're gonna say. Daniel, I'm not sure if it's in front of you right now. Can you also tell me how much Apple has appreciated over the last 5 years?
But let's do one question after another. So just the first question. So let's just say, Daniel, what was the average? Daniel, what was the average? I think you need that
calculator. The one you had in part one. Get that calculator.
The dividend yield over the last 5 years is 1.37.
1.37 average. So I was just wondering, to get £300 a month. To get £300 a month on the property cash flow, which is for a very basic 100k property, £30k deposit, to get the equivalent of 300 a month, how much Apple stock would I need to buy?
You said 1. What did you say, Daniel?
1.37.
37.
Is there enough zeros on the calculator?
I wasn't prepared for this question.
I mean, you calculated it pretty quickly based off of 5% last time. So I thought on this one you would have been able to. I mean, I can calculate it for you if you want.
Feel free. Yeah, sure. 3.6. Did you figure out?
No, I'll let you do it.
Oh, okay. I wasn't prepared for it, but I'll calculate and I'll come back to you.
We'll make sure we share the number on this episode. Let's move into I think a relevant part of this discussion, which is more advanced strategies. And the whole idea here is to share with the listeners, if they were to pick stocks or stocks or property, what could they look forward to in this game if they stayed in longer? So maybe if the stock guys, Shua's kindly brought up the number. So just to be clear, you would need £225,000 invested into Apple stock to earn £300 a month, whereby you would only need £30,000 in property to earn the same. So that's cool. And I think that just speaks to that.
But that's also cash flow.
That's if you want the dividend.
Correct, and that's what.
But that's also taken into consideration. Obviously, I'm mentioning Apple, which is still a growth company. So Apple is not the best scenario that you would take. Apple is not the best investment you would take if you're looking for passive income. You would go for somewhere like Coca-Cola or like AT&T, which are offering 6%, 5%.
I just wanted to use the example that you highlighted, Ollie. That was it.
No, that was more in the response to the top companies do not pay dividends, not the value of them paying. Amazon doesn't pay dividends, but again, like we mentioned, you have to look at the full picture, right? So if I'm adding to the full picture over the last 5 years,
Apple has gone up by over 485%.
Tell me what property you have that's gone up that amount, or if you were to invest in property, you never
Tune
find
into-
it.
Fair point.
tune
No,
into-
but fair
tune
point.
into
But I
part
think
three.
I think to Shuwell's point is that the number Daniel quoted is all on paper. So I think you just need. I think we're talking about perspectives and context. So that 400
I
and
hate
something
that
percent
terminology on paper. I
is on
hate that
paper.
terminology on paper. You guys love to say this terminology on paper.
No, but
Do you know this? Yeah. What do you mean about
but
this
it's-
terminology? It's all on
But
paper.
again, we're going back to which return on investment are you focusing on? Daniel spoke to the asset class. We're referring to the dividend yield, the cash flow per month, right? So whilst it went up 400 and something percent, it paid 0.7%.
No,
So
on
0.7%
average,
on
1.3.
on average, 1.3. So
Yeah.
on average, so
Yeah.
this is
1.6.
it's just people to understand
Yeah, but
how to
you
look at.
also have to factor in the company may not decide to pay dividend. They have to. It's all down to company and shareholders vote. So
That's
it's
an argument.
still
That's an argument for us, still,
still-
not your side.
it's still subjective.
Hmm.
I'm trying to give a balance. I'm just giving a balanced viewpoint because the
Okay,
same
okay.
1.37 might be low, but it could actually be high. It could be lower certain years. It all depends on the company.
Right.
Let's switch.
Yeah.
Let's switch to advanced strategies. I think there's a good opportunity to do that. So, do the stock guys want to go first on what can stock investors look forward to if they're in this game?
I think for anyone listening, you may not have the luxury of seeing the video clip, but Olu just did a very, very deep stretch of his neck. So he's warmed up for the song.
No.
He's warmed up. He's locked and loaded. Olu just
I think
Daniel,
also,
do you
to be
wanna-
honest with you, one thing, and
Yeah.
I think just we could, Ollie, you mentioned something which at the beginning, which you mentioned something in your speech, which I think is correct. We're actually looking forward to this because of our limited information on the stock market. So I'm actually interested to understand what, from an advanced standpoint, you can do, right?
Yeah. So Daniel, do you want to start and then I'll chime in?
Yeah, you can do BRRR.
Is
Oh my
that
God.
pronounce it? How do you pronounce it?
And what that is buy, rise, and I add an S in sell. That's one.
I like that.
Oh my
I
God.
like that.
That's
So
solid.
buy,
That's solid.
rise. What was the last part?
And add an S sell.
So-
Jokes aside,
Okay, that's good.
Jokes aside, when it comes to stocks, though, in terms of stocks themselves and not necessarily trading, the strategies you can deploy are somewhat limited, depending on your time, your level of sophistication and knowledge, because you can get into some advanced strategies that can put you at a financial loss. When I say financial loss, one would be short selling. So short selling is when an investor will borrow security and then sell it in open market in anticipation that they will buy it back for less money. But the reason why that's risky, as we saw in earlier this year, January and February with GameStop, is if that price rises, they have to, fill in that gap from the security that they've borrowed because of margin calls. And I won't go into what margin calls are, but it means where the money's, they're losing money, they need to add more money to their account to cover that shortfall. But the strategy, obviously, of short selling is you would borrow security at a price. You anticipate that in the short term, that the price will drop. You'll then buy the security back, return it, and then profit the difference on the price going up again. So that's how you would, one strategy in short selling. There are also, scalping is one, but that usually happens within seconds and minutes, where you would buy a security, you buy a stock, and then within a few seconds, that price will go up, and then you sell it immediately. So you profit on the small differences, and you obviously accumulate that, and it compounds. But those are, quite risky strategies. I would say very simply, when it comes to stocks, the strategies you can deploy are somewhat limited. The best thing you can do is really understand what you're buying in anticipation that it's going to grow. And really and truly, in the stock market, you're not going to, in the event that there's something going to rise in the short term, you can get the profit, the difference. But usually you're looking over a period of time that stock is going to appreciate, like Amazon in the last 15, 20 years, like Apple, like what people think Tesla is going to do in the next 10 years, is that that price of the stock is going to increase, and it will compound as well as you start to reinvest your profits. Ollie, anything you want to add?
Yeah, I'll say just echoing on what Daniel said. I think in the stock market is limited when you want to do it the correct way. And I think we have this platform, so we have to be responsible with the advice that we give. So I think Daniel and I echo the point of buy and hold is always the best strategy, right? You can, if you look at and it's actually quite funny because I was listening to the Warren Buffett and Charlie Munger give their annual returns, and they pulled a chart where it looked 20, 30 years ago, and they looked at the top 30 companies in the industry, in the stock market. And they looked at the new 30 top companies right now. And holding for the long term is what guarantees you the massive amount of returns. So back, I think it was 30, 40 years ago, the top company was only worth, maybe it was 300, 400 million, right? And now when we talk about Apple and these companies, we're talking about trillions. So you can see the best way to go about the market is buying and holding for the long run. But like Daniel mentioned, there's other more riskier ways to see vast amount of returns. Risky if you have limited knowledge. If you obviously have the education, understand what you're looking at, you can obviously take advantage of it. One option is what Daniel mentioned, which is the selling short. So you have put options, call options. This basically allows you to be able to trade without physically owning that particular stock. So all I'm basically doing is I'm basically predicting, understanding which direction the stock is going to go. So I'm saying, hey, I want to borrow, let's take, excuse me, Apple, for example, which is trading around 230, 200 and whatever right now. I can borrow that stock, right? And if I believe that Apple is going to drop to, let's say, for example, 100, I can have a date where I say I'm going to purchase now for 100 and give that person back the stock. If I borrowed it at 200 and whatever, I've now purchased it at 100. I now make that margin between that, which you can imagine can give you like a vast amount of return that you can make. On the other side, it can also do that. The another strategy you can take into consideration when looking at the stock market, which our property guys talk a lot about, is leverage. Yeah. You can also do that with the stock market. It's called margin trading. So what this allows you to do is basically borrow to be able to purchase a stock. So an example is a stock might cost 2,000. I might have 1,000. I can borrow the additional 1,000. If the price of the stock goes up, I get to basically capitalize on whatever that total increase is. Exactly the same as property. Obviously, nowadays, the loan to value is at a lower amount. So with property, you can borrow 80%. When you're looking at this, most companies, you're looking at 50 to 25% that you can borrow. But again, that's another element of trading that you can do. Another one that a lot of people do right now is swing trading, which you can do on the Forex, etc., where you're really trying to predict the direction that the stock is going to go. So using data, a lot of this now you can see, and I think it's going to be the same with property. You're moving away from the passive element of investing. Now you're moving to more active way of investing, which can give you a large return. But what swing trading is basically doing is you're trying to predict which way the stock is going to go. You pull an option to purchase at a particular time. What I typically say, or when people typically do this swing trading, what you try to do is you have sell or buy options. So what that means is you want to limit the amount of exposure or risk you have. If you're doing a swing trade based on like Forex or a particular commodity, you want to have a limit to say if it drops by 5% or whatever percent, I'm going to limit my exposure or how much I can lose. I think all of this is going to sound very complicated to a lot of the listeners. So I'm not trying to make it sound simple. It's not. But I think one of the key things I just want to mention is that there's a lot of ways when it comes to property, when it comes to stock, that you can make a large amount of return. but it's more risky. So if you look at people like Warren Buffett, if you look at a lot of the millionaires, billionaires that we know, they have made a large return through either stock market or trading. Some people trading on the stock market, which you can't do with property, just because, and maybe the guys will correct me, just because of the fact that it's such a large amount of capital you need to be able to initially purchase and start like investing and flipping and trading when it comes to it. But yeah, I hope that was clear. I'll stop now. So if you guys have any questions, I can clarify.
No, I think first of all, I think for me, I think these are some great pointers for people that are interested in stocks listening to this to perhaps veer off and start researching some of these points. Some of them were new to me. I think the only question I have, it was just more out of curiosity and not to challenge, is on the margin trading. At what level can you actually start to borrow? Was you able to find that out?
Yeah, so certain platforms will allow you to borrow. Obviously, they cap. It's based on your portfolio. So a lot of times you need to have some sort of asset that it's just like with property, right? They'll do background checks to make sure that you can afford it, all of that stuff. Same with stocks, you need to have a certain asset. And I think most times they say you can borrow up to 25% of your portfolio. Portfolio value is what you can borrow for and again. So at least that way, yeah, go on.
I was going to say they always advise that they always confirm you have to agree to your consent that you know what you're doing, because it's a very advanced trading strategy. Because of course this is away from investing, this is away from stocks, this is about now trading, even contract for differences, using derivatives, which are very complex type of financial instrument, because you can use a commodity as an underlying, you can use a foreign exchange currency as an underlying, you can use a stock as an underlying, you can use interest rates as underlyings. There are many different types of underlyings you can use, but you'd now put yourself at risk of huge market fluctuations. And what many people don't know is even the governments enter, for example, inflation swap contracts of betting against inflation rate changes, because you're hedging and speculating of rises or decreases in the future. But with an option contract, you have the right but not the obligation to buy or sell at a future date at the exercise price which you agree today. But with a futures contract, is slightly different, is where you agree that irrespective of the price at the future date, you have to trade the underlying security for the agreed price today. Then also you have forwards contracts as well. But with the options contracts, there is a premium that you have to pay, and also deposit to your margin limits as well on a daily basis.
Yeah.
But if you want more information, sign up to my advanced course, which is
links in the bio.
I'm doing it. First 50 people, 50% discount. But yeah.
But I would say just to listeners again, and I said this before, and just because I feel like we need to be responsible with our platform, I always say any investment or anything that can make you a lot of money, you've also got to look to say, okay, what is the risk of it losing you a lot of money? So
protect the downside.
Protect your downside. So a lot of these options, and what I tried to articulate was that you should always have some sort of sell option. So like as you're going into a trade, if you're expecting it to swing up, have a 5%, 10% reduction where you sell and then you take that loss. Because I think on both of our sides, one thing you should learn when it comes to investing is protect your principal at all costs. So especially as we're building our wealth, a lot of us just don't have money to just be throwing away. So as you're growing that principal, protect at all costs. So don't risk everything on just one particular bet or investment, because at the end of the day, that's what your family relies on. That's what you rely on. That's your generational wealth. So again, protect your principal at all costs.
Part three. Warming up to part three. No, I think guys, great pointers on some advanced strategies. So don't you notice it's so much nicer when we get along? Can't you see?
Nah, it's not the same. I want that energy. I want that energy.
Cool. No, okay. So just a couple of things I think from a property side that investors can look forward to the longer they're in the space. Daniel alluded to it earlier. He made obviously a joke out of it, and I think the very first place I'll go to, it's advanced depending on the type of deal, but I think what I want to communicate to the listeners is the best way in property, to leverage this kind of asset class is to basically run the following model. And it's basically buying a property or an asset for cash, forcing the appreciation by adding value to the asset in the form of a refurbishment, so a new kitchen or a new bathroom, and really bring it up to a level of standards, and then taking the asset then to the bank to basically get that financing. And that's what is called as a buy, refurb, and refinance. It's one of the, if not the most powerful strategy in the property space, because what it allows people to do is it allows you to take your down payment that you would have put into the asset and recycle it, right? So as you refinance out, you can then use that pot of money to then go again into other assets. And a lot of investors have actually built up portfolios using one pot of money in the beginning. It's also a way to actually see much higher returns. I know that's something that, you know, the stock guys have mentioned. If we talk about being able to pull your money out, right? A lot of guys that are doing the buy, refurb, refinance are looking at returns of 50, 60, 70, even infinite returns, because all their money has basically been pulled out. So buy, refurb, refinance, if you haven't heard about it before, it's the optimal way to leverage a property, an asset. So I don't know if you want, you want to go into.
So I'll build a little bit on Davido's great point, and that's about leveraging the buy, refurbish, refinance, and taking it one step even further. And that one step further being, I think Davilo, the example that he gave was an example if you wanted to do that with your own money. But in the property space, what makes it even more powerful is if you're able to build relationship, build contacts, and demonstrate to potential investors that you have this proven track record, and actually helping other investors with their money where they invest in the deal. So you have to put little or minimal amounts of your own money and basically go through that same process that Pavila has just laid out about buying, refurbishing it to appreciating the value, and then refinancing out, but doing it with other people's money. Now, why this is also another great option is because it's actually cheaper than using your own money, because all the money that we have, especially if we're people who are working and then investing on the side, that money that we receive from our salary, for example, is net of tax. So your tax rate, let's just say on average, is 30 to 40%. For you to get your income into your bank account, your salary, you've had to forgo 40% of that income. So it's cost you 40% to get that 60%. Hypothetical example. Whereas when you're investing with other investors' money, of course, there's a risk involved. You need to make sure you've got the right documentation, you've got a good track record, all these other things as a given. But then once you've got investors' money, then basically you're committing to an interest rate to them, which is basically a much more tax efficient way for you to, again, build a portfolio and help them get a good interest on their investment, while also accelerating the buy, refurbish, refinance strategy as well. So just to build a little bit on Pavilo's point, using other people's money to accelerate that strategy even more.
Oli, just quickly, just a couple more points before. I think something else also. It's just a term that I kind of wanted to maybe clarify. I know Olu mentioned it again very passionately in part one, and
can I guess what this term is?
I know, yeah. He said, but I'm with you. We're on the same page. We're on the same page. Trust me. He said, no money down type deals I call BS, right? The first thing I'll say. I
said that with my chest.
Yeah, you said that with your chest. The very first thing I want to say to that is you shouldn't call BS on things you haven't done yourself, right? And I think you provided me with that advice on the stock market. So that's the first thing. The second thing is I think it's a well-known fact that when we talk about no money down, we do make it. It's not clear enough because people like to market it a certain way, but in the essence, we all know it means none of your own money, right? And I think that complements the point that Shual mentioned, which is in this property space, the best way you want to play is how can you leverage other people's money in order to do the deals so you can actually then receive a return. So by doing that, to what Shual was talking about, you actually then achieve no money down form of deals, which basically means none of your own personal money left in the deal. So that's it. The other strategy I kind of wanted to talk about, and it does speak a little bit to Olu's point in part one, not because it's Olu, but I think Olu mentioned a point around passive income and really understanding passive income from a property standpoint. I think you're right in the sense of people make the assumption, oh, if I'm earning X amount in rent, then I'm going to get that every single month. And that's not necessarily the case. It depends on the type of asset. Some are more smoother than others, but I think there are ways in which you can actually really secure that passive income. And this, I think, goes into more advanced strategy. So a big tip actually for a lot of people really listening to this and taking notes, if you really want to become successful in the property space, one of the best things that you can do is get very close with your local council, right? It's one of the best partners that you can actually build a relationship with in the property space. And a couple of reasons. One, I think there are arrangements, right? Like supported housing, right? Emergency housing. Councils are always looking for additional homes to basically put, let's say, people that are in need, people that have maybe come out of prison that are looking to reform into these kind of homes. And what they'll do is they'll give you actually a fixed contract over a period of term where they're actually paying you a guaranteed amount of rent for that amount of time that you've actually agreed, whether there's someone in the property or not, right? Now, what that entails obviously is bringing the property up to a certain standard. A lot of people actually, one, don't know about it, and two, don't like the idea of having someone who perhaps is in need inside their property. But it's a very great way of actually being able to secure part of your income in the property space. Advice I'd actually give is, as you start to expand your portfolio, I'd recommend 20-30% of your portfolio of building that kind of income, right? Working with the council and securing those kind of contracts. The other thing I also wanted to mention, that's from a securing the passive income standpoint. The other benefit about working with the councils and working with the governments, and this strategy works from, your local council in Leeds right up to Starwood Capital with CEOs like Barry Sternlit, is the fact that you can actually borrow very, very cheaply working with the council and working with the government, right? So I can give you an example. Wakefield Council, for example, I've got someone in my network who actually gets interest-free loans from the council to actually do the development, right? And that's a way of him actually being able to raise the value of the property without putting his own personal money in. So there are advantages by building certain relationships with certain parties in the property space that can make the property journey smoother and less costly. So yeah, I just wanted to bring that point to the table.
Thanks, man. I think just to build on that theme of trying to make it relatively passive or tapping into untapped resources to make your life more passive, probably a lot more passive than margin trading that the other guys were talking about. But I think this element of passiveness, I think I just want to mention another example where if you have a property and you have it's taking up time or you're having challenges, you do have other options that you can take with the property once you own it. So you can, of course, give it to an agent to help manage for you. So this is a way to free up your time, and it's, again, tapping into additional resources. As well as that, you can even give your properties to people who are doing rent-to-rent schemes as well. So there's some great companies out there. I can give a plug to a couple if you want any. But there's some companies out there that basically take their properties off landlords who maybe don't have the time, they don't have the energy, maybe they're a bit older, etc. And they want to have a much more fixed rental figure. So then what they do is they give it to another firm, and these are firms that specialize in rent-to-rent.
Guaranteed.
And guaranteed, and they basically sublet it on a per room basis, depending on the market and depending on the availability. So that's just to emphasize the passive element to property investment.
But on that point, I think sometimes one of the misconceptions is people think rent-to-rent is only designed for the tied landlord. You can actually find property investors themselves giving their properties over to rent-to-rent operators, right? Because it's a way of guaranteeing some form of their portfolio income. So yeah, I think these are some good advanced strategies. I mean, there's a lot more, vendor finance, assisted sale, and some of these other points. But I think the ones that we have given are good actionable items. People can look into them, do a bit of research, and actually, I think you could probably start relatively earlier in your journey than later.
I think, thank you. I think these are some very good points, very valuable, very valid, and I think someone can use them. The only concern is, as Papilo mentioned in part one, someone who's doing a 9 to 5 with limited time outside. This would require a lot of time, effort, resources, studying and knowledge to build up that acumen as well. So it just depends on the time that the person can sacrifice. Because I can tell you categorically that with trading and investing in the stock market, you don't need to know what vendor assisted selling is. You don't need to know what BRRR. You don't need to know all of these terminology and jargon, which makes it sound so very sophisticated. You just buy, you hold, you sell. Simple.
Daniel, what did you call it? Was it called scalping? Is that what you called?
Yeah, scalping. Yeah, scalping.
Yeah, scalping. That sounds to me like it takes quite a long time to understand how it works. But no, I think Daniel, in the end, the point you're making is
scalping. Scalping. The strategy is very simple. I buy now, it goes up in a minute. Sell. That's it.
During the 9 to 5. But I think Daniel, the point that you put onto the table is, I think when we talk about these advanced strategies, is what people can look forward to, maybe at a point of doing it full time or later on in their investment careers.
No. I joke aside. I know, of course, they're very friendly.
So it's but yeah, guys, final points and comments.
Let me just say,
before we bring it home to a close.
Can you hear me? So
yeah, go ahead.
I just as much as we joke around, I just want to take this time to be serious and just say to our listeners, you should be privileged and honored for the information that you're getting from this podcast. Just in terms of ᴠɪᴇᴡs and Pabilo have taken years of studying. They've invested a lot of money in regards to getting this knowledge. And from all the information, right? Go on, Daniel.
Echo somewhere, sorry. I don't want this to be echoey for the final.
I've gone on mute. You might have to start that again, Oliver.
Okay, so let's cut this out, start again. So jokes aside, I think a lot of times and this is one aspect that I love about this podcast, we can have jokes, we cannot take each other very serious. But I just want to take this moment to say that the listeners are lucky and privileged to have a lot of this free information and gems being provided by Pabilo and ᴠɪᴇᴡs. They've studied the property space over a large amount of time, invested a lot of money into themselves to a point where they understand these different strategies. And I think the strategies you guys mentioned were amazing, right? Fantastic. There's one that I just will never be able to truly agree with, and you guys can help me understand and clarify this is
sure.
When you spend someone else's money, or even when it's what you class as no money down because you're spending someone else's money, how does that get returned? Is that then when you're paying, or how does that deal close? Because I think people like to say, okay, I spent someone else's money, but you have to pay that person back. And if you're paying that person back through a loan, which yes, is not your own money, quote unquote, that debt is in your name, which is your money. You have to pay interest on that particular money you borrowed. So I don't like no money down, because it just seems like money just came from nowhere, and that's not the case. Yes, you might have not had to spend money from your own physical pocket and you've leveraged or borrowed it. But at some point, if it's when you sell the property in 10, 20, 30 years time, you will have to pay that out of either your appreciation, because again, 100% of that should have been yours, but you had to pay it back, or you've had to pay back based on your interest that you've had to pay over the years. So can you guys just clarify that element?
So I'll try to clarify. I think first of all, it's coming from a standpoint. If someone today is buying property the traditional way, to ᴠɪᴇᴜs' point, they're having to basically use their post-tax money in order to buy. Very expensive, very lengthy process, a traditional process. And some of our mentors will say, by the time you've actually got to your targets, you run out of life, because it takes some time. So the whole concept of no money down is more of a mindset, right? Because it gets you to understand that there's ways to acquire assets without actually going through that trading time for money and using your own personal funds. If I go back to the example we spoke about, the buy, refurb, refinance, you're absolutely right in the fact that you actually have to pay these funds back, but you're not paying it back. The asset is paying it back. At least that's how property investors are going into the deal, right? So let's say, for example, you look at a buy, refurb, refinance on, let's say, a house of multiple occupancy type of deal, which you're developing. You can raise the finance, right? Then buy that property with cash, forced depreciation by doing the refurbishment, and then on the refinance, what comes out of the bank, because the bank now have securitized the property by providing the loan, you're then using that funds to pay back the investor. Now, I think maybe to your point, it comes with a level of risk, your ability to pay back. But in that entire transaction, you can go through that process without using your own personal funds. And I think,
see, when you mentioned the part about the refinance part, that debt that you have in the bank is towards you. So that's your money in terms of, yes, it's leverage, right? But
compare it to the traditional path. I think that's maybe where we need to go. So
I totally
if you compare it to the traditional path, then I haven't saved 2-3 years to buy the property. So that's really where we say that's how we want people to think about no money down, right? Or at least none of your own money.
Yeah. Okay.
So
Great.
Trying to be slick. Cool.
I didn't want to say that, but that's what it sounds like.
Great. Guys, look, I tell you what, as we haven't cut each other up as much as in episode 1. I've actually enjoyed both episodes, cutting each other up and also giving each other a time to speak and have a bit more respect. But I hope for the listeners, you have enjoyed part 2. We really wanted to sort of give this some time and space because we think it's a very important topic in the finance and investing world. We hope we've given you more points to reflect on. In this episode is really what you can look forward to if you decide to go with property and stocks and the longer you stay in the investment game. So with that, we're going to come into a close, and I want to say to you, hope you enjoyed this. Remember, stay tuned for part 3, where we really end with a bang. We talk about our personal cases and we give our personal reasons without it being challenged as to why it's property or stocks.
Are we dropping numbers in the next episode?
Yeah, I think we will.
It's up to how you want to drop your numbers.
If you want.
It's not to brag though. It's more percentages. Daniel, go ahead.
So thank you all for listening. As P said, join us in our next communal episode where we break it all down. In the meantime, stay well, God bless. If there's any feedback for us, any comments you have to share with us on the first part or the second part, we are always welcome to hear from you, our trusted and valuable listeners. You can find us on Instagram at Take Flight Podcast or email us at takeflightpodcast@gmail.com. Stay well. We'll see you soon.
Take off, take flight with you.